Good morning, everybody. Oh, yeah. Okay. Good morning. Hope everybody's doing well. Um, I think we have a pretty good agenda today. I'm pretty excited today. Um, because obviously we had a very good Top Traders Unplugged with Niels and Richard, and I've been going over this, and it's pretty outstanding. And I learned a lot. I think I learned a lot. That's what I'm going to get to the bottom of. What exactly should I have learned? I've listened to it a couple of times, but I haven't done my deep dive, with going through every sentence with YouTube and looking at the transcript, trying to catch those two in something. But so, anyways, I wanted to hopefully get Richard to comment on some of what he spoke about. It's really fascinating. I hope everyone has had a chance to listen in. It's amazing stuff. I think it's definitely possible to learn how to trade and know some rules and follow the rules and make money, But it's really fun to get deep into some of these issues that should have very little to do with our overall success other than making us more confident. And I suppose knowing exactly what's happening in the markets or the theory behind what's happening is fun and can lead to some creativity and improvement, I suppose. But I really do enjoy um, listening to things like this. So I'm going to go really quick, and then hopefully Richard can take over and correct, and then add a bit. You don't have to do the whole thing you did with Niels yesterday for an hour and 30 minutes, but um, this is my takeaways, and this is some quite amazing stuff. And when I get a hold of something, I exaggerate it, and I want to push it even further and get in trouble. So some of my comments will probably be similar to that, but. So I learned in this podcast that there are basically two types of trends, let's say, exogenous and endogenous. And I think what was being said is that 90% of the trends are endogenous. And that's the ones we're trying to find. We're trying to get the long-term trends that last a long time, months and months, maybe a year. And the characteristic of this type of trend is that it starts with a seed, but no one really knows what's going on inside of this market. It's happening inside the market. This truth about the new fundamentals is being unraveled very slowly, and it takes months and months to play out. Maybe the corn trade, something that's continuing to go. It hasn't gotten crazy, and it just keeps going up for the past since the fall of 2020. Um, but then the other type of trade, the 10% of the trends, exogenous, it's news outside of the market. I think it's COVID maybe, and this news comes out quick. The market moves dramatically. We know why. The trends are short-lived though, and I think that its characteristic is there's a lot of news. I think, and this is just 10% of the trades. So good news for us because it doesn't sound like my long-term trend following is that suited to these trades that kind of skyrocket up and then crash. And that could be Zoom or Peloton or Uh, probably some other ones too. Oh, natural gas. Maybe. I'm not sure. Um, I'm pretty sure my big takeaway to stay out of trouble was it's pretty much about news, and which is kind of funny because I didn't understand these in the way that Richard explained it. But in 1983, when we were in the Turtle program, a good part of what we were taught was fade the news. And if there's too much news that is affirming your trend, you should be nervous about the trend ending. Now, when we all went out and started managing money and started using computers and technology, that sort of contrary opinion, which is what they called it, sort of got lost. I don't even know if Covell picks it up in his books. I've talked to him about it on his podcast, but I'm not sure. But it may not even be the same thing, because this was rooted in the news and maybe extremes amount of news. So with that, I will let Richard correct and expound.
Thanks, Jerry. Look, what grabbed me about Jean-Philippe Bouchard's research was that it it really cements this philosophy of ours, and it gives us actually extra ammunition to explain some of the things that we might have difficulty explaining to traders that don't adopt our styles. So one of the things that you always talk about, Jerry, and we all certainly do as trend followers, is it's a very counterintuitive approach. Why do we, for instance, buy high and sell low rather than the reverse? And I think it's really clearly explained if we can imagine that market behavior comprises two broad forms of mechanics. And this is where Jean-Philippe's research came in, because what he said was he only investigated what he regarded as major unidirectional price moves. He actually wasn't investigating volatility per se, but more the unidirectional major price moves that on the 1 minute time frame. And he found that that 1 minute time frame also scaled up into the larger time frames. But what he did find was that these two forms of event um, account for these major price moves, which he can describe by exogenous events, which are news events that come from outside the market in. But that only comprises 10% of these major price moves. 90% arise from these endogenous factors from within the market itself. Now, another thing we have difficulty explaining to people is that we don't predict with our particular technique. And that is supported by the fact that these endogenous price moves, these 90% of the material unidirectional price moves on the 1 minute timescale, are attributed to things that you cannot find a definite causal factor for their occurrence. In other words, when you look at these events that materialize from within the market itself, they can be attributed to a host of minor events that impact the interconnections that exist in that market. So they can be small events that trigger it, but their impact or their magnitude of event is severe or significant. So you get this non-linearity between the causal seed that causes them. It grows to a critical point over a period of time, and then it dissipates. So this inability to predict the cause sort of throws into contention a lot of the things that you and I, Jerry, often frequently question. Everybody talks about risk premia because they're thinking in terms of an engineer's mindset where they want to identify a causal reason for something to occur. But these complex markets don't comply that way, because these causal factors that actually create these major price events, it's like finding a needle in the haystack, trying to find that particular cause, which could be any number of reasons for that cause. And these endogenous events is because in this market, which is a series of one-to-many relationships. So, for instance, a broker or an institution such as Lehman Brothers, or an institution such as or Madoff's institution, was a single institution that connected to millions of traders or millions of participants, and that one-to-many relationship creates these critical event failures when one of the important architectural interconnections in that market fail. And that can be a variety of causes that actually does. It doesn't have to be inflation, doesn't have to be these. It could be, someone turning up to work one day and actually, burning down the server or blowing up the server or whatever. So that gives so much credence to that non-predictive nature of our technique, because if we separate the market into these two forms of broad behavior, which one relates to major price moves in the non-linear region of the market distribution of returns, that's what we're focused on. But the majority of traders are focused on this alternate market behavior, which is associated with a tendency of a market to oscillate about equilibriums, create these repetitive patterns This behavior, or this alternate behavior that we're not interested in, we exclude from our trade results. We don't want to be involved in that linear, repetitive behavior of a market because we prefer to target our efforts towards things that generate absolute returns, this non-linearity that occurs in this tail region of this market distribution, this other form of behavior. And so our technique is therefore incredibly counterintuitive to the majority of other traders. So we can't, for instance, make, when we hear someone talking about, a particular system rule, if that applies to these alternate systems that are not trend following, we could almost reverse that rule and apply it to ourselves because there's this total reverse position we've got to take. So we don't predict. We need a total systematic rules-based process to stop us predicting because everyone wants to predict, even us. And this total reverse counterintuitive process is actually how we extract the edge from the market. The opportunities arise from the fact that we are totally counterpositioned towards the predictive mindset that likes to look at predictive certainty, all of these things that are characterized by that behavior that is not in the area we're concerned with. So that's where I got so much joy from the way Jean-Philippe sort of separated out, or his research basically gave us so much fuel for our philosophy to not only, it gives us so much more strength in our argument when we say these things.
Very good. I wanted to ask one question, though. It sounds like we have three categories now. It's the endogenous, the exogenous, and the small trends and small losers. And because some of these exogenous trades, they're big profits and they're kind of outliers at some point, and they may crash a bit. So, my big question, which I forgot to ask, is when I see the news and it's pretty obvious that it's of that category, can I change my exit to get out quicker? Because I want that profit as well.
I wouldn't do that, Jerry, because what I'd do is I'd say our trend following technique, I wouldn't consider that our trend following technique doesn't capture the moves from exogenous events. I think they do, but that is a different form of signal to these endogenous events. The endogenous events take time to rise and time to decay. So what that's meaning is that we've got this period in the market distribution of return, or in the market distribution that is serially correlated. In other words, there's a memory that exists in that signal that extends for a long period of time before it decays. And what that's saying is, unlike a repetitive pattern, these major price events aren't repeat events. They are shocks to the system that take a long time to decay. So we can't apply any repetitive process to attack them. We've got to apply, a breakout process to catch these one-time significant features. So we need these very loose pants to be able to capture all of these possible forms of these significant outliers. But I would not be separating exogenous and endogenous and saying we're only focusing on endogenous. I think we're focusing on both because they're both major price moves. We've just got to recognize that we can't predict which one, if we know that there's a significant news event, the reason that JP sort of assigns this quick signal decay is because a news event is a causal reason for that price move. And when everyone knows the cause of something, there's less uncertainty. So they might realize that their trade position was wrong, but they quickly realize that this shock event was caused because of this tsunami or this external shock that comes into the system. So it decays very quickly. The reason for this long extended period of decay with the endogenous events is that people cannot pin down the cause of these things, and uncertainty remains in the market for a long period of time, hence the different profile on the longer decay. So let's say we treat exogenous and endogenous the same with our trend following breakout models. We're just after these major unidirectional price moves, full stop. We're not trying to predict anything about it. We've got these loose pant models that can target that feature. So the other form that exists in that other region of the market distribution that we're not concerned with is this linear noise, effectively. And we can't avoid getting some of that in our trade distribution. Ideally, we'd like to only focus on these major price moves, but inevitably in our hunt for these outliers, we're going to catch this noise, the whipsaws, the times that we're wrong, all of these things, but they're linear features and it's a linear noise. So all we need to do, therefore, is develop a process that is like a distillation process that says, how do we reduce the level of noise so that we can increase the frequency of these outliers in our distribution without predicting? And that's where our process comes in with our long look backs and some of the processes we use, the rules-based processes, actually achieve that. But I don't think we're necessarily aware of that. But that's what I highlighted in that blog post is this is an outcome of why we're using long look backs, because it's like a distillation process that really increases reduces the noise impact against the outliers that we're catching with our loose pants models.
This doesn't sound like good news for AI and machine learning, though, does it?
No, so AI. So those techniques work well in repetitive pattern-based environments. So they don't work well in this uncertainty region that we're targeting. So there's very few models that work well in our region. So effectively, we are defining our attention towards that tail region. I don't care what AI does. It might be very successful in the predictive regions that we're not targeting, and I think it will be. But that's this convergent area which we're not interested in. So yeah, they can get an edge out of that, but the edge they're going to get is from this linear increase, the increased frequency of repetitive pattern. But they're only going to get really the benefits of the linear features in that pattern. So we've got a sort of an extra juice, we've got an extra rocket fuel by attacking these non-linear features. And that's why I think our model is superior, because we really are forcing our attention towards the things that matter, these major transition events or these major change events. And AI can take whatever they like out of convergence, I don't care, but they're not going to be affecting our region. I don't think you'd need these non-predictive models, loose pants models. I think, some of the things that Derek's talked about with these options models, that they are good little divergent mechanisms for the short-term convexity in our tail region, but our long-term and medium-term trend following models are really good as well. So that's what I think.
I think where AI will excel, or where it's going to, is to have multiple predictive models and basically find a way to have them interact with each other. So to almost have predictive power, but then have different models and knowing when to switch to which model. Well, obviously, where we're looking at is on a unpredictive path. So yeah, indeed, I don't think um, AI would majorly impact it that way, because it has a different philosophy almost.
Agreed, Jeff. I think that it's a turf war. They won't work well on our turf, but we won't work well on their turf. But let's stick to our turf because we know what we're doing on our turf.
But the problem seems to be that when we run into issues that with our strategy that they would do better at, we will lose a little bit of money. And if they run into issues where we are going to maximize our profits and they're not prepared, they could lose a lot of money.
Exactly.
Hey Jerry, your last question just got me thinking. If we should exit when the news come or something like that. Uh, I think our approach at Trendfall, at least my approach, is to be extremely, perhaps dangerously humble about understanding what markets are doing at the moment. Sure, there is a reason behind price action and prices being where they are, but it's extremely difficult to pin out what this reason is in real time. Why are soybeans price moving up? I don't know. They are doing their thing, and I'm just following it. I'm happy to follow it. I remember a couple of weeks ago, my models triggered on soybeans, and I was talking with this friend of mine that's an analyst from agriculturals, and I said, oh, one model is on, the next one is up above in 1442. And he answered me, "You're crazy, man. Soybeans never going that high, and if it does, it sure will come down back. So please don't take the signal if your model triggers it." And I said, "Sorry, man. I have to do it. This is the way I trade. You can do your thing, I can do mine, and that's fine." And then yesterday I was talking with him, and I said, "You see, soybeans crashed above 1442, and now he has a story, an explanation, or he's looking for an explanation for why the price is what it is." What I mean is, again, there is a reason for all this, or there may not be any reason at all. But in real time, at the time of the trade, it's useless to find these reason to. I think it's useless to find this reason to gain confidence or not on the trade. Just do the trade.
I exactly. I listened to the JP podcast as well on Top Traders Unplugged, and that guy's pretty smart. So I was struggling a bit, but I was still picking up some of the points that Richard made as well. And it's almost like they're saying, just hope that you don't hear any news. You do not want positive feedback on this trade. And with the turtles, Rich would say, oh, you prefer negative feedback. You would prefer the fundamentals to be negative and the trend to be positive. That's the best trade. You don't want, you've heard this cliche, uh, I like it when the fundamentals and the technicals agree. Well, they would say the opposite. It's when they start agreeing after you've been in the trade for, well, a few months. With our systems, we were short term, but when you start hearing things about the news and people are bullish, and the lowest source, the better. So the headline in the New York Times about soybeans, not so good. Uh, but if you get into a Uber, it used to be a taxi, and your Uber driver says, "How about those soybeans?" You probably should right then, get out of your soybeans. So I think that it's really fun to hear that and have it kind of confirmed in a different way. But I would definitely recommend both of those podcasts, um, Jean Philippe and of course Richard. Richard, where did you post your follow up blog? On your blog or on Niels's blog?
So on Niels's blog, he's got a new thing called. There's a new section he's just added. So we'll be putting more and more blogs on there. So I'm not sure how he plans to do it, but he certainly asked from the podcast whether I'd be prepared to write up a blog on it, which I did. And I'm wondering whether the same's going to be occurring with other co-hosts as they go, maybe as a way to sort of provide a bit of detail or whatever, or some examples of some of the things they talk about on the podcast. Might be a good idea.
It's quite interesting because at times news have quite a predictive power in terms of that sense, but I think it jumps in and out. So price in itself is not per se, well, in my opinion, price doesn't per se move always on news. Sometimes it's just a fat finger or a group of people that have a lot of fear and just sell when it's a long trade. So there's always a reason, of course, but that reason might not always be that obvious. So the news itself it depends in what regime we are, but sometimes it works and sometimes it doesn't. So that's why it's helpful to not even have to focus on that predictability, because in that sense you can filter that out and not have to worry about it.
For me, I have to keep reading and going over the same material and formulating my questions because another really fascinating idea that Richard mentioned a few minutes ago that's in the that he mentions on the podcast as well is this one-to-many relationships, the cascading. For some reason, I think this stuff is just really fascinating, to to learn about. So I encourage you to read the blog, Listen to the 2 podcasts. They're really good.
Actually, if you're into relational database programming, Jerry, it's something that you pick up. So a relational database is one that uses a one-to-many relationship in determining linkages between data. So you realize when you're doing these relational databases that you're dealing with sort of non-linear information. So because you're using a one-to-many relationship, the power of these databases is bringing together variables that are effectively correlated. So it's not just looking at a single correlation between 2 variables. This is looking at a correlation between multiple variables. And I just notice the number of articles we're getting on Twitter these days, which look to biology as a system to perhaps explain some of the things that occur in financial markets. And for instance, I noticed that the follow-up podcast on the volatility series was an excellent one where this bloke starts talking about quantum physics and how the models of quantum physics actually can be used to explain some of these, these financial markets. Not necessarily because they're the same. It's not saying that these markets adopt quantum mechanics in their system architecture. It's that some of the problem solving that was done in quantum mechanics had to deal with issues that we deal with in financial markets. For instance, the imperfect information held by an individual agent means that we can't treat each individual participant the same way. So in a system such as an atomic system, where we're dealing with a system comprising all of the same agents like electrons or protons or neutrons, they are all physically structured the same way. So their variables are all the same. However, when we're dealing with participants in a financial market, their variables are based on this imperfect information. And that imperfect information is drawing on variables in their knowledge base that make sense to them, gives them a reason, or the way all of this knowledge in their brain correlates together gives them a reason for cause and effect. It's not necessarily that there is cause and effect, it's just that the way they link these important bits of information as this imperfect information, because they don't have all of it, they've only got a bit of it, they have multiple variables that are different to another agent. And so the problem is when you're looking at collections of these agents, you've almost got to group them into similar behaviors, because those agents that display these similar trading behaviors tend to have similar variables, but they're not all the same. There's these differences. And this is where this compounding error occurs in the mechanics of a market, because it's not fitting together these perfectly sort of perfect fundamental variables together. It's bringing together this sort of imperfect information of different agents, which all collectively interfere with each other or compound each other or amplify each other to create this amazing structural architecture inside a financial market, or this complexity in this financial market. So the great thing about these podcasts we're hearing with John Paul and the later podcast we heard just the other day with Harry Krishnan and this other gentleman, fantastic, because it really reinforces the complexity and why we need simple rules, and why it overthrows this sort of traditional economics that is using this naive statistics. And we've got to think with better models how to understand this market.
Just one quick point here. When you were talking about the simple rules in the podcast, Rich, it occurred me a metaphor. Trend following, it's akin to a mosaic. I don't know if my pronunciation is correct here, but sorry about that. It got me thinking about those those floors in ancient Rome or something like that, where you have tiny tiles, tiny stones that in itself they are simple, but you arrange them in a way that they become something beautiful. They become something much more complex, and you start with small patterns that you can achieve with, I don't know, 4 little stones, but when you put them together, it becomes an amazing picture.
Yes, Bruno. And look, I'm aware of a lot of physicists who are going down this path. So there's a bloke called Stephen Wolfram, who is very much looking at what you're talking about. And what you're referring to are these simple rules-based cellular automata. And what that is, that's where you get these simple patterns who adopt particular rules depending on what the neighbors surrounding that pattern or that black tile is doing. So what it is, there might be a handful of rules, 4 or 5 simple rules in these very simple sort of cellular automata that, as you sort of they're programmatic in that you've got to basically start off in a particular state, run these sequence of 5 very simple rules, and the outcome are these glorious, complex, clearly non-random patterns created from this structural relationship that exists between agents in that system. So, and that's effectively what the argument for complex adaptive systems is. It's saying, hey guys, in these complex adaptive systems, there's a distribution to apply here that is much more applicable than a Gaussian distribution. It's called a Pareto distribution. In this world, small edges consolidate into massive gains through the Pareto basis. These selective advantages compound with small changes and create these magnificent sort of wins for those people that adopt this basis. So it's a wonderful time in financial markets. I'm reveling in it because it's really overthrowing this orthodoxy, which I think is about time we started getting serious and really started looking as a way to use alternate models to best describe what we do.
Yeah, and both the market may have these simple rules behind this complex behavior we observe, and it's hard to pin out the rules if you're just looking at the outcome, as well as our trend following systems have simple rules. And what amazes me is that our simple rules somehow work well with the market's rules that we don't know.
Yeah, and these simple rules, they haven't been defined in a vacuum. These simple rules have been passed on by generation of trend followers that know, or they basically have a validated track record to say that those simple rules actually work. So you don't need to understand the mechanics of the greater system. You just need to know those rules that are particularly pertinent to surviving in that system.
I couldn't help, I couldn't help but think of, maybe I'm going too far with this, but the missed opportunity for CTAs to sell themselves as crisis alpha or sell them as a good addition to the 5 or 10% of the portfolio and diversification, when in fact there's I don't get the impression that there's a lot of stock trading that uses these methods that we use that is a real benefit and can keep people out of trouble by using the trend following, small losses, letting profits run, shorts, or at least going flat, when the major trend has reversed. And so we don't even trade stocks necessarily. That's a missed opportunity. We don't tell people, hey, here's your favorite asset class, and you're doing it convergent, and you're going to die with these 50, 60% drawdowns eventually. And it's just a screwed up situation where we missed a tremendous opportunity in just trying to fit in rather than getting to the bottom of the truth and saying to people, we really, really have something to offer you. You should trade currencies and commodities as well, but whatever, if you're in our fund, you're going to get this divergent trading with the stocks. But if you want us to just trade your stocks only with our trend following, that'll be much better than what you're doing right now.
Totally agree, Jerry. I think, I'm sick and tired of having to make a sort of it's almost like Well, look, I don't like the way that we settle for taking a small piece in a bigger portfolio, because there are just so many reasons for why we do believe it's trend following or nothing. And I think with this research, I'm just hoping that if we can maintain this momentum and say that there is real significance in what we do, it might increase allocation strictly towards trend following without necessarily having to, always compromise. That's the word I was trying to think of. Compromise by, oh, look, we're prepared to take a 20% allocation in this greater portfolio.
The markets are pretty crazy these days. I don't know if anybody has any comments on what's going on. I'm slowly, I've didn't do well on the upside in stocks because I traded the single names, and a lot of mine were too diversified, different from the stocks that are driving the S&P. So I haven't been long much for a while, but then my short indexes have been kicking in for the past few weeks, and just the price action is so weird. It's interesting that I was kind of able to get short some of these, I guess mostly non-US indices, not too far from the highs. That reminds me of '08, where the S&P hit a 200-day low in January of '08. Plenty of time to sidestep or profit from the massive sell-off. And then it just seems to be this crazy fight during the day. Dow up 500, 600, down 500, 600, back up 500, 600. Within the day or at night and in the morning, it's just these massive moves. I don't know, is the Fed buying the S&P? I don't know what's going on. It seems like, or maybe I've read a bit this week that retail is buying the dip and buying the ETFs. But it's kind of a strange period. I haven't gotten run out of any of my shorts. It's just like intraday, the volatility is kind of unusual. I don't think I've seen this in a while.
My explanation, which I thought was very interesting, if not intriguing, and especially of what happened on Monday, is that if you remember last week, a lot of options expired. So what happens is, most dealers, market makers, and other actors need to rebalance their books on the following day, which was Monday. And because the market moves so fast at the open on macro news, on general malaise and sentiment, they basically got whipped by gamma, and they sort of had to scramble for to cover their short gamma positions at what became the low, because then obviously kicked in a cascading of rehedging, which pushed the market up. I don't know if it's true or false, but I second your comment, Jerry, that this volatility is getting a bit too much and a bit unusual. So we might actually see effects of that. And I don't even know how many of you guys follow Charlie McElligott work on the market gamma, keeping track of CTAs. I mean, his work is interesting, but I'm not sure I agree with most of it or all of it. However, I do pay attention to these gamma strikes. And so, it looked from his analysis that actually, we were right in the middle of this region where dealers gamma flips from long to short, and the big sell-off flipped a lot of people onto this short gamma side of the ledger, and so yeah, I sort of give a little bit of credence to that explanation, but it's interesting, but yeah, the truth is, we will never know what happened.
Yeah, I see a lot of talk about this action from market makers, and I don't know if you guys know, there is a great page called Squeeze Metrics in Twitter, where he tries to map what's the potential order book for a couple of equities, and I think it publishes for free this order book for the S&P. It's interesting. It's an explanation. I find it compelling.
what was going on in Bitcoin from a trend follower perspective. If anybody had any views on that. Sorry, maybe I have a bad connection.
Anish, I attended Derek's podcast yesterday, and it just made me realize how little I know about cryptocurrencies. But look, I do trade Bitcoin. I'm short Bitcoin, and it's just because my system rules are applying to Bitcoin exactly how they're applying to commodities. So, I'm short. That's all I can really say.
I trade Bitcoin futures and Ethereum, and I do it the same way. I trade everything, and I am sort of surprised, and I like to trade it. I was one of the first people to trade the futures because it's liquid and it's different, good enough for me, right? So I am just kind of disappointed that mainly that it goes down when the stock market goes down. But I don't really care too much about it. I ended up trading a pretty healthy amount of Bitcoin initially, a good position, and then I reduced it when I added Ethereum. I reduced it a bit to make it more of an equal, like all the other markets, and then I'm going to add a few of the blockchain or whatever stocks, the companies, Coinbase, and but those charts look the same as pretty much similar to Bitcoin. They're all in downtrends. They're probably worse than Bitcoin. So, but it's kind of disappointing that it's not doing better, and it's not something kind of fun, and it isn't taking over for gold or whatever. But I would just hate to be in a situation where I really care about any of these markets. I love my little markets, my 150 on my way to 200. I love them all like they're like my children, but I definitely don't think about them very much, and I don't have a psychological. None of them have a psychological hold on me. It's just trend following.
Jerry, what do you think about the principle of not worrying too much about correlations of your markets? In other words, if you don't worry too much about the correlations between return streams, inevitably what that means is you probably will get higher drawdowns, simply because there will be times where they are all positively correlated in an adverse way to you. So, but because we've got these trend following models that cut losses short, our losses are linear, but we might get a large number of linear loss events to create this sort of greater drawdown. However, when we do get these correlated regimes with outliers that cascade across markets, we of course get the fruits of all of that. So, and those fruits are typically non-linear outliers associated with this degree of persistent correlation during those periods. So, in other words, we're accepting this greater chance or greater probability of non-linear outliers across different markets, and the price we pay is when we get it wrong, this degree of linear sort of unfavorable events that increase our drawdown. So if we can accept the drawdown volatility, isn't it better to go for things that are slightly highly correlated and not worry so much about uncorrelated markets?
Of course, but I learned all that from you. So, or you made me more dedicated to that whole idea. I think the for me, it's just a question. Yeah, I'm going to have higher drawdowns, but I'm also going to have higher profits. So I just don't want to have a lot of the losing trades in a row. So we have some weapons for that, which is the multiple system approach. I have different entries and different exits, and then I trade the different markets, and I trade them small. I'm thinking of currencies now, where I'm short all the currencies basically, but I put them on at different times. And I'm doing all I can to make sure that as soon as that I don't put on all my currencies in one day and then I take a stop loss on all of them. That's the downside for me. Not in 6 months, these shorts are making all kinds of money and I've made a ton of money in these currencies. And then they all rally on the same day or the same month and I have a bad day or month. Yeah, I don't care about that. So I mean, I'm gonna care about it, but it's just what we have to deal with. I'm really concerned. Boy, I put 10 currencies on today, and I took my stop loss on all of them, and that's crazy. So you don't want that to occur. Um, one of the things you brought up, I can't believe I forgot this, but this was an amazing fact. I love this idea that you mentioned. I think it was in the podcast again. I had never thought about this, but it was something about how if you don't trend follow, you really are using correlation as a risk control. Oh, you're very intense about this correlation because you need to get the correlation correct. Whereas if you're a trend follower with stop losses, you don't even care. Your own record is saying, oh, sure, I trade heating oil and crude, 90% correlated, because I've seen a few times in history, heating oil doubled and crude kind of sat there. And I'm capturing that outlier. I don't, correlation, whatever. Um, but, and then again, as you know, if you trade 150 markets, every position is so small that so what if you have high correlation amongst a few of the energies, it doesn't even move the needle very much. And certainly the stop loss doesn't really move the needle much at all either. But if in fact that's what you meant to say, something similar to that, it would be interesting for you to expound on correlation versus stop losses for convergent and divergent traders.
Yeah, look, I'm glad you like that because that was the intent. What it's saying is that whenever you talk about portfolios, everyone talks about correlations. They they fear it. We've got to get the most uncorrelated relationships we can exist. And what they typically do is they search in the convergent world for these convergent models that offer these uncorrelated relationships. But you ultimately find that nearly all of them are effectively long GDP solutions. So effectively, they all become correlated and bang, the portfolio goes down the gurgler. So correlation to me is a method to control risk. That's not a method. That's a close your eyes and hope arrangement, very much like a buy and hold arrangement. You just hope that the particular systems that you're allocating into your portfolio don't suddenly flip and become all highly positively correlated at the worst time. And that's inevitably what happens. So to me, that's not a way of managing risk at all. That's just a way of window dressing to get these smooth equity curves. The real risk mitigators, the real risk mitigators are the things we adopt in our trend following models. The small bets, the tight stops, the trailing stops, they are the true risk mitigators because they actually release risk steam from the portfolio. They don't hold on to it. These other correlations hold on to risk. So you're just hoping that the correlations don't flip. You're not actually releasing risk from the portfolio, but these other mechanisms that we deploy do. So, this allows us to therefore, once again, go counterintuitive to the traditional mindset. Who cares about trading more highly correlated markets? Let's embrace it because we're not only going to get the outliers that exist in a single return series, we're going to get outliers when these positive correlated events occur during times of market crises where the outliers are magnified many times because of the cascading that occurs across or vertically across asset classes, as opposed to serial correlation, which is a horizontal correlation that exists in an individual return streams. We're going for both forms of benefit in both horizontal correlation and vertical correlation, where everyone else is trying to say, no, we don't want horizontally correlated assets or vertically correlated assets. We want to avoid that. We want to keep everything linear, smooth. And we're saying, no, we beg to differ. Once again, a counterintuitive mindset.
Hi to everyone. I was in the mountains, so connection was very poor, and I was hearing partly your discussion. It was very interesting, and I wanted to say a lot, but couldn't. So, first of all, I want to say that I was very impressed by the last previous episode of Top Traders Unplugged, and this Richard's theories. And I want to say that I want to mention one my note now. I had a lot of notes there, but one I want to mention now, that Richard said that this is a trend following is a science of complex adaptive systems, and we are using these very efficacious simple models to extract this age from the market data. And these simple models haven't been designed simple because not because we are dumb. These simple models was designed simple because we use simple rules in these complex adaptive systems, which is incredibly hard to predict. So I wanted to say that I'm very impressed by this, and I'm proud that in fact I look at this like sort of maybe like Richard is a founder new sign. Great. Okay. We're talking about how to say that of course you change time to time, but the most uncorrelated assets is commodities, the most uncorrelated commodities, and of course I agree with that stuff that Richard said, that first of all we must understand the importance of our small bets and our diversification. So here's my point also. But the correlation across asset classes, I think, is very, very important. But we must have as much more asset classes as we can, and we must take. And as I always said, and because it's really very, very important for me, it must be commodity sectors is the most uncorrelated sectors.
Thanks, Oleg.
Yeah.
Perhaps I could speak a little bit for why I think correlation is important, and not just a gimmick or a trick to make everything linear. And again, it goes back to what is your real view of the world? I mean, in what system do you think you operate? If your returns are purely arithmetic, meaning every single position adds up, then yes, I mean correlation. You can say correlation is smorelation. It just doesn't matter. It's really ridiculous. Just multiply the number of line items and go and hunt for outliers. But if you're trying to allocate capital every day across a variety of different return streams, then you have to do something about your allocation. You couldn't simply say 1/n does the trick, and it doesn't, because sometimes, as we all know, things move together. Sometimes things become orthogonal with respect to one another. So if you had a way of running your portfolio always with orthogonal in an orthogonal mode, you can load up on one side and load up on the other side, be sort of prime for outliers on the long side and the short side. Of course, this is impossible, but that's what correlation tries to do. And I do agree with you guys that this is pretty much like volatility, because it's the same expression. It's the same second moment matrix. Volatility is the diagonal, correlation is the off diagonal. But estimation is a problem, and any error gets wildly compound, and things can go horrifically wrong. But I don't actually think it's just an accounting or a temptation to make everything linear and to control everything. I think there's some real substance.
I was being a bit harsh, Bruno. I apologise.
No. I mean, there's no need to apologize. I'm fascinated by it. I think, again, the biggest difference is that you guys are okay with saying, all returns can be added up. I am a bit more interested in figuring out, the opportunity cost of asset A versus asset B. Volatility drag for me is a problem. So, it's interesting how our respective philosophies drive the investment process, which is as it should be. But
Bruno, I'd say that trend followers, we are actually applying geometric returns to individual return series. So in our method, where we are targeting these non-linear outliers, so if you imagine, if we not only considered drawdowns, but we also considered the return stream magnification. In other words, a step up in that return stream. So, we always talk about drawdowns, but if we look at the level of uplift in a return stream versus the level of downturn in a return stream, we can see that in our trend following models, they're asymmetric. In other words, our drawdowns are smaller than these step ups. And that produces geometric returns at the individual return stream. Rather than arithmetic returns, it produces a geometric return series or a path-dependent return series that when you then summate the individual geometric paths together, you get bigger bang for buck than what a smooth the compilation of smooth return streams in an arithmetic way do. So I'd be saying that we do focus on this geometric return streams, but we're thinking of it at the return stream level as opposed to the trade level, as opposed to the portfolio level.
Yeah, that's it. That's it. When I say geometric, absolutely, I agree with that. All of it, all that you said. But when I talk about geometric versus arithmetic, is how what do you do when you compile from individual trades into portfolios? Because we all have multiple positions on. I look at the product of individual returns. You guys look at the sum of individual returns, and therefore, I think the asset allocation process is a bit different, has to be different, because as Jerry says, he really wants to optimize for the trade, i.e. make sure that he can actually take the trade, the next one, the existing one, and just to squeeze out every possible inch of juice out of that, or drip of juice rather. And instead, I am more worried about optimizing for the portfolio. So the two things actually, I think, make you look at correlation in a very, very different way. And I keep, banging this point because I think it's been quite revealing actually listening to you guys. You made me understand that before. I didn't understand it this as well as I do now. But I think there's a profound difference, on how you look at correlation if you only think about the trade or if you worry more about the portfolio. So that's my point.
Yeah, and look, I think we can sum it up with a philosophical stance. I think trend followers are going for what we refer to as absolute returns, but I think alternate models that are attempting to sort of balance their portfolio, they're going for less sort of volatile return streams, but there is a price to pay with that over the very long term, I feel, which is a sacrifice of the degree of absolute returns generated for this smoothness of returns.
Oh yeah, for sure. And you also pay in terms of positive skewed. So, my approach is always going to be less, it's going to have a less positive skew than yours. That's for sure. I mean, you have to pay for it. There's no free lunch and all of that. So yes, I completely agree with you.
Do you feel that we get away with this sort of sloppiness and imprecision on caring about this portfolio the more markets we trade? I feel like that with so many markets, I've said before, I've run this analysis in a back test when I'm trading 100 or 150 markets, and I'll say to the computer, trade crude 5 times bigger than I should trade it, and the numbers don't even move. My daily volatility I do it on purpose to make it even worse and pay attention to correlation less, and then the numbers hardly move because I'm just trading so many markets, trading each one so small. And then at the same time, maybe I'm saying at another time, oh, I'm doing that because I want to capture these outliers. And the next time I'll say, oh, I'm doing that because I want to have the small bet size, which is really part of our risk control. And then finally, I wanted to mention that I've never heard anyone, even people who don't trend follow, it's amazing to me how it's almost unanimous that when people talk about correlation, everyone says the same thing, and that is they're not stable. So that's another. Well, yeah, even in this, even not talking about the outliers. Of course, 2 times or 3 times in my life, heating oil doubled. I'm talking about even other times as well. The correlations tend to be quite a bit different. And then when you overlay trend following on top of the correlate on these markets that are sort of correlated, they become less correlated sometimes.
I think that it's less an issue if you have a more markets to trade. For example, if you have 100 markets to trade and you have different allocation to different sectors, so to a lot of commodities, a lot of stocks, a lot of currencies, maybe. It's less issue than you have, for example, 20 markets, and most of them will go in one direction. So, for small managers, it's a big problem to choose the markets with more probability to be uncorrect. So,
To answer Jerry's point, then you made two very good points. One is does our imprecision on a trade by trade basis get improves by trading more markets? And the answer is absolutely yes. And the second one about correlation not being stable. The problem with the correlation, again, and I don't want to hammer this point too much, but yes, I mean, traditional ways of estimating correlation, it really is imprecise. Pearson's correlations and rolling correlations, and what I keep saying, you can't use Python, and there are some libraries that do lots of very clever things, but those metrics are not going to work. However, there are better ways of measuring these kind of things, and do you get a more precise or a more stable view of the world? Yes. There are even more advanced ways, and in Derek's podcasts, every now and then it keeps the names sort of keep coming up, and it's this thinking in graphs, in terms of graphs. So if correlation is just a map of lots of edges, and so nodes and links between nodes, well, then this graphical view of correlation returns a picture that can be quite different from standard Pearson's correlation, and the relationships tend to be more stable, i.e. they shift, but they don't shift because of tiny measurement differences. They shift when you need them to shift. So you can pick up some more information there, and you can do better. And this has been my drive. I mean, there's a difference between talking about vol targeting, and again, it's the same thing, because volatility is just a diagonal of that matrix. Or variance, and correlation or covariance is the off diagonal. So there's a lot of there are a lot of answers to be found in advancing the ways in which we measure dependence in our portfolio. But then again, I go back to my point, which is you can even say, I don't care, because I am the Jerry Parker, and you are the Jerry Parker, and therefore I maximize the trades, and therefore I have two equity accounts, open equity and closed equity, and correlation, smorelation. That makes perfect sense. I wish I had the ability to say that. I can't do that, but it makes perfect sense. It's logically very sound. And then again, everything that Richard says, let's go and hunt for outliers. Let's go and look at where the distribution diverges away from normal returns and stuff like that. If I had a way of estimating it, and we had a little thread on Twitter about that, it would be fantastic. I'd be ditching all the things, and I'd be trading like you guys do. But I don't think I can, and therefore I default back to to my methods. But I agree with everything you say. I mean, there are obviously pitfalls in what we do, and they're very well known.
Bruno, without getting too much, I don't know, personal, why do you say you can't?
Oh, because it kind of gets a little bit too tedious and complicated, perhaps. But okay, you have to think about when I build in a portfolio, I have a set of signals, and then I do the compilation, which is okay, given that, and each signal is obviously standardized, so that every unit of capital that I can allocate, it's completely fungible. It can be to equities, it can be to commodities, it can be to everything, or it can be oil, or all the different instruments that get traded. So what you want to do what you want to do is make sure that you've got the best positions that you can possibly have. So it's a matter of signals, i.e. the strongest or more precise signals going first, but also it's a matter of correlation, because the portfolio is one unit. So if you put a lot of the same type of risk, well, your portfolio becomes inherently imbalanced. And that's why I need to keep track of all these kind of things. So, what I'm saying is I couldn't swap, these my methods for Jerry's with and then reconcile everything, saying, oh, but I take care of the portfolio. I would have to completely reject my sort of my fundamental philosophy and move over to um, to the side of saying, okay, I do not want to worry about the portfolio anymore. I want to worry about maximizing each individual trade. I think there are two diametrically opposed views of trend following. So, when we sort of debate whether your way of doing it is the only way, I actually think that I am, well, I know I am. I have positive skew in my portfolio. I am hunting for outliers. I'm doing all the things that you guys are doing, but I'm doing it differently. So I have less positive skew than you are. I am probably getting less absolute return, certainly on the trade by trade basis, but probably, and I'm just postulating here, I think that if I'm good at measuring correlation and volatility, I can trade a little bit more on each individual position and make up for the less absolute yield that I can get out of every trade. So yeah, I'm quite happy to say that I am giving up return, though I might not. I don't know if it's true. One thing I'm giving up skew. I'm paying for this. As Richard says, smoothness of my returns. I'm paying through skew, and I'm happy to do that up to a point. So I optimize for a few things, but I definitely have a positively skewed portfolio, even if I'm not optimizing the return of each individual trade, and even if I do pay attention to correlation.
Yeah, but I think once again, I think it would be difficult to beat the large portfolio of a CTA that trades 100 markets, and it would just be difficult with all the for a client to say, wow, how can you trade 100 markets and you don't have a lot of diversification as much as other people who don't trend follow. I don't think that's the case. So no, I do think that you can have lots of diversification, and 90% of the time, and then people get very uncomfortable when you let the profits run. But yeah, I think we do a pretty good job if we just keep adding markets of hunting the outliers and seemingly not paying any attention to the portfolio. But when you start adding all those markets, it could hardly get better. I guess I'm going to prefer, obviously, to add the markets and let the markets do the work versus adjust my system. So my system does too much of the work, especially when it comes to compromising on the capturing the bigger trades.
Yeah, but I think Oleg has a point here. Once you reach 100, 200 markets, it matter much less than when you're small and escalating the way up to 200 markets. When you have 30 markets, I think you have to pay more attention. Not perhaps not on a too technical level of calculating correlations and codependencies, but at least a sectoral spread between inside your portfolio.
That's exactly right, Bruno. It's the same principle as a sound engineer uses to dampen noise in their signal. So as you increase your diversification to 100, 200 markets, provided that each of the return streams is slightly uncorrelated with each other. They can be fairly highly correlated, but the noise is reduced. The noise is dampened through the offsets that are produced by the superposition of return streams noise against each other, because each return stream possesses a degree of noise in it. And when you superimpose another return stream on top of that return stream at the portfolio level, the two noise, because the noise is effectively a random signal in that return stream, the randomness of each of the return streams offsets each other. It's exactly like the physics principle you find in wave tanks. When you put waves together and you find that waves neutralize each other, but signals tend to amplify. So that's why Jerry doesn't have to fear correlation, because he's got this level of capital with very small bet sizes that allows him to significantly dilute the impact of noise at the portfolio level and be confident that what he's catching is more and more outliers, more and more of that signal, whereas we, with our limited capital, do have to worry about the level of correlation at the portfolio. So this is a capital limitation exercise that most of us face, but Jerry, of course, with the size of his portfolio, he's got this freedom to move, which I'm very envious of.
Oh, and I'd like to add something here too, perhaps contradicting myself. When we look at single markets through the lens of trend following along a long period of time, we don't see much difference of performance. At least I don't see with my back tests, meaning that most markets will have that similar statistics. Most markets will show up a couple of outliers that will pay for their lifetime of trades. All of them will have a lot of small losses and some small wins. And what I mean is, if you're trading over a long period of time, if supposedly time is not a limitation for you, you don't have to. I wouldn't worry much about market selection, about portfolio construction. I would add them irrespective of what their sectors are. The problem is time is a limitation, unfortunately. So if I have a small account, I have to pay a bit more attention. I would say that I have to pay a bit more attention. But over time, over a 10, 20-year window, I don't see much difference, at least in my back tests, if I am loaded in some sectors or some others.
I find that, and I know why that's the case, Bruno. So it's a matter of scale, and it's a matter of how you look at your equity curve. So if you imagine we're only trading over a 6-month period, in that 6-month period, the equity curve has significant volatility of it, because the majority of that equity curve, in fact, nearly all of that equity curve, might just include random noise. So the degree of dispersion in returns over a 6-month period can be significant, because in a random array, we can have significant positive results of good randomness and significant negative results of bad randomness. And it feels as though your portfolio is moving significantly. And when you compare it against other funds, trend following funds, over that same 6-month interval, there is massive dispersion in returns. However, when you zoom out and you go to 10, 20, 30 years, you actually find that the dominant material impact that is changing the shape of that equity curve are the outliers you're catching. That noise that you were so concerned about at the 6-month period, that material volatility you saw there, suddenly dissipates. And when you look at it, you scale back out and zoom back out, you see that all of your equity curve is significantly responding to the outliers in the series. And that's why you find over the very long term, 30 years or whatever, trend following models tend to converge, because the dominant impact of that portfolio result is on the outliers they've caught, which is materially moving that equity curve. All of that volatility you saw at the short-term level dissipates, and that's because of the zoom out feature when you look at the long-term performance. So when I look at Dunn or Jerry's Chesapeake, and I look at the monthly returns, and I look at a 6-month period, 6-monthly returns, I see significant variation in it. Lots of reds, lots of blues, lots of reds, lots of blues. But when I zoom back out and look at the entire 30-year, 40-year history or whatever, you can start seeing how the shape of that entire portfolio equity curve is being dominated by the outliers that they're catching. So provided you're a good trend follower using good rules, you find that over the course of a very large sample size, your process sort of distills out the outliers and their performance results, and the rest is chaff, mate. It's just volatile movements you don't have to worry about. So you've got to go in and attack the problem with very low leverage and with a process that is looking at decades of performance, as opposed to being worried about a small sample and the volatility that's accommodated within that small sample.
Yeah, exactly. It's almost as if an outlier will show up after 100 trades. So you have only one market, you'll have to wait for 100 trades to show up when you finally get your outlier. Whereas if you trade 100 markets, perhaps they will show at the first round of trades you're doing. Tying back up to a point we were discussing about diversification and correlation and etc. I find this amazing that for a convergent trader, correlations and diversification is a means of defense for their portfolio. Whereas for us, it's completely offense. We have to be diversified because we have to allow our system to be exposed for this outlier that will show up.
Great point, Bruno.
Another good point you brought up on the podcast, Richard, was I haven't fully thought about this, but I did. I was beginning to like it actually, because I can be very hard-headed, but then I can change quickly as well, and sometimes I change too quickly. I have to go back to being hard-headed. But of course, I came up with this idea of trend following plus nothing, and trend following, classic trend following. I say that a lot, and so I was thinking when you and Neil started talking about, well, Neil, did you think about how few times we said trend today? I was like, what? You should say it more. But then you explained yourself, and I like it. I mean, I think this is probably a good idea. Um, I don't like the term managed futures. Okay, so we're going to move away from trend and trend following for the reasons you mentioned, and then we're going to talk more about outliers and complex adaptive systems and one-to-many relationships and cascading, and give people a better insight that this is something interesting and new for them. Let's hunt some outliers and put us in the portfolio, because really we are different, and we will make money. And oh yeah, and before I forget, I wanted to know if you saw that article from the Financial Times that I tweeted about. It was an article by Howard Marks, and so many of the things he said in there were I totally agreed with, and especially I think the last paragraph was something like, it's all about the compounded annual returns. It's all about the money we make, nothing else. Well, you have to stay alive. You have to keep your clients, and then make them a lot of money. And I think that's an underappreciated feature from a world that's dominated by sharp and math and smoothness. And I think if you ask the client, they may say, "Oh yeah, I prefer a bit more money and to a little less volatility."
Yeah, I love that comment from Howard Marks, because I love Howard Marks and I love love his mind and how it operates. But I was taken aback by his comment regarding, trend followers, and his comment regarding if all of these retail traders are trading trend following, then they're certainly going to suffer in performance. But the way I've reconciled this with Howard Marks is that Howard Marks, to me, has this counterintuitive mindset. So his particular process, which is a value method, basically, effectively identifying companies that have got significantly undervalued and basically going into them. It is a counterintuitive approach. Now, our approach is also a counterintuitive approach. Now, he might sort of wrestle with understanding our approach, but I think the commonality between Howard's approach and our approach is that it's counterintuitive. So if you think of a market as being a zero-sum game, and you're thinking of the term counterintuitive, what that's saying is that you will be positioned in the market to the opposite direction to what most other trader or participants are doing. And this is where the flow in the market occurs, because when the most get it wrong, this mass wealth gets transferred to the smaller number of counterintuitive participants that are taking the other side of that trade. So our technique definitely does position us in a counterintuitive way to the bulk of other participants. Howard's method also counterintuitively postures his trade direction to the reverse of what the majority are doing. And that's where both of us, I think, are getting this windfall of the edge arising from the zero-sum game with this flow. But the processes are different. So I'm not saying that you can't use other processes to be counterintuitive, but I certainly know that our trend-following approach is not just practiced by a few firms with a very long-term validated track record. There's a huge number of them. So it's a very strong, robust technique that's got survival embedded in the track record. And I think to be skillful like Howard, or to be skillful like Warren Buffett or Charlie Munger or those sort of people, you need this sort of this amazing experience and these additional skills that nearly all traders won't get over their lifetime. They're supported by research houses and these things that we can't access as traders. But we do have a method which we can access called trend following, which is a rules-based process that, provided you spend the time invested in learning these techniques from those with a validated track record, you've got a good chance of surviving and prospering in this market.
I could see myself saying something similar to what Howard said, because I think it is a problem that to use trend following in a undisciplined, unsystematic way. It's really, I think really what we do is systematic trading, first and foremost, consistent, disciplined, robust, and uh, then we've adopted trend following that's the best idea we've come up with to fit underneath that what we're demanding of our process and structure. But I just would it's probably unlikely to assume that most retail traders are doing that. Are they selling when the market goes down? Of course. Are they getting back in when the market rallies? Not as much. We've talked about studies done that showed that never was a problem for people to panic and sell, but they didn't get back in. So are they grabbing elements of trend following, some diversification, some shorts, maybe taking small losses? But we just know that without the complete dedication to applying these rules every day in all the markets all the time, it's far short of what we wouldn't say to these people, oh, just grab a piece of what we do. It could work out really well for you. I wouldn't say that. I mean, it may work out well, but I don't really know. And so I do think that he might have a point, but you're right, he's not going to be in our camp of trend following. It's just sort of funny that over the years I've tweeted a lot of his memos, and it is a lot about diversification, taking small losses. And then the article in the Financial Times was pretty much mostly centered on don't sell so quickly, hang on. And I think he even mentions trends. He says you're not going to get these big trends unless you hang on to the winning trades and don't just sell because it's going down. I mean, I certainly don't. You look at some of my trades, you'd be shocked. That trade is in a downtrend. Well, not according to my system, it's not. So I'm still long. I'm pretty sure I'm still long Bitcoin. I didn't want to admit that, but my longest term system is still long Bitcoin. It never got out. It participated in the first crash. It's participating in this crash, and it's probably my most profitable system. It looks embarrassing on Bitcoin now, but sometimes I'm selling those breaks, and sometimes I'm not. It just depends on what the system is doing.
That's exactly right, Jerry. And look, I don't think you can sort of take parts of our process and think that you're a trend follower. And I think the majority of retail traders do. And we've already sort of explained how with limited capital, there's already a significant obstacle to achieve our objectives of trend following. But the biggest problem with the retail traders is their lack of discipline, their lack of appreciation of all of the golden rules that Bruno's already sort of discussed. Previously, we need all of these golden rules to work in tandem together. It's a complete suite of rules. There's no missing element. It's comprehensive. So, I think there's a lot of detail to our technique, which I think a lot of retail traders underestimate. And personally, that's why I think the narrative needs to change, because I think so many traders actually do trade trends, but they're not necessarily trading these outliers or focusing on these outliers through this process that we've adopted. They might be following a trend that's a random signal. They might be trading a trend that's actually part of a bigger mean reverting cycle. Um, you know, that's why the narrative, I think, needs to specialize towards a better understanding of what the professional FMs do that sets them apart from this common understanding of what people think trend following is all about.
Yes. Hi, everyone. Yeah, I totally agree. In terms of trend following, it is counterintuitive. I remember who said that, probably Voltaire, like common sense is not common at all. And we still, like for me, I'm still learning how, okay, you have to be very disciplined, and you have to embrace change. Even I teach my kids to do so. And I believe also in trend following, hope is a dangerous word. Don't even try to use it. So that's just what I learned.
Exactly, Lulu.
Okay, may I post completely, perhaps different question? I'm trying to learn to trade the LME, but I can't find good material. I think their contracts are slightly different from what we see at the CME or the ICE. Can you guys help me? At least pointing me to materials. I don't know.
Oh, hello, everybody. I thought Bruno was still talking. I'm sorry. Um, I didn't know if it was a good time to ask a question, maybe a simple question, maybe not. When it comes to back testing, do you all, particularly when it comes to individual stocks, do you all take a stock and back test it and say, no, that stock doesn't work in trend following? Or do you do that with markets also, like the lithium does not work in trend following? How do you handle that?
Well, I don't do that. I trade markets that add diversification to my portfolio, regardless of how they're back tested. But let me get to Bruno's question that he asked. So I've traded the LME since the 90s, and so they're good markets. I like to trade them, and but they are odd in the sense that they're forwards, and they're quoted each day on a 3-month basis, 3 months from today. And so we usually, it depends on your size, and I suppose, but there is one common day that everybody kind of coalesces around. I think it's the third Wednesday of every month, something like that. So it's usually a two-step process. You initiate the position in the 3-month, and then you roll it to this third Wednesday, and that's the most liquid day. That's the most of the days, most of the where most people put the position. So you have to do that two-step process. I suppose it's similar to FX, some FX markets or some brokers. When you do FX, you do the spot, and then you choose the day to roll the forward. And so, I'm not sure why they do it that way. To make money. And honestly, we trade New York copper futures and not LME copper. So, if there were futures on aluminum, zinc, nickel, lead, and tin, we'd probably trade those futures as well. But those are great markets. I made a ton of money in them. They're different. They're big uptrends this year. Past year and a half, they've just been fantastic. So I love those LME markets. I love those Brazil markets, but I'm having a hard time figuring out how to trade some of those markets as well. But I'm keep working towards that.
Yeah, thanks, Jerry. Sorry about Brazil. And I have to figure out how to do the LME. I think there's an aluminum contract on the on COMEX or NYMEX, not sure. Anyway, CME. But I think it's not liquid enough. I think it's pretty dry, actually. And to the other Jerry's question, I don't evaluate backtest on a single market alone. I always do a big chunk of backtest on a lot of markets to see if the system works, irrespective of what market it is trading, to get the notion if the choice of parameters is robust enough.
Would you not trade that market though if a certain market didn't test out well? I I I do that. When I first started trading, well, Rich had a list of markets that he didn't like, and I think wheat, for instance, was on this list. So he loved corn and soybeans, and he didn't like wheat. And I think a part of the function of that is, I don't know, I haven't thought about it a lot, but I think part of the problem is that when you start extending the parameters and you're trading longer term, now wheat is much better. So wheat had maybe too much noise, and if you're trying to trade it too short term, historically it hasn't trended as well as corn and soybeans, let's say. But if you're a little bit longer term and you move medium to long term, then the choppiness of wheat doesn't take away from the fact that it too has these big outliers. But as good trend followers, we don't think the future is going to look like the past in this particular way. We're waiting for these events to occur that you can't predict, that maybe have never happened before. The fundamentals have never been around before. And so you can't look back. And then these backtest performance on the markets is heavily dependent on the number of outliers and how far these outliers have gone, a very small sample size. And your best guess is what has the group of markets done versus what has this market done. Um, because I trade a lot of wheat now, and it doesn't trend as well, or it hasn't recently, but I don't think that means anything for the future.
Just really quick, I would include or remove as a market from the system based on different considerations. For example, very short-term interest rates, I wouldn't add them because they're not responding to agents' choices, much more to central banks' choices. But that's a different consideration. It's not because it performed worse in the back test. It's because of the nature of that market.
Jerry, just this is how I approach the problem. So The way I view markets or market data is I believe that individual markets do have their own unique signature. So there are certain characteristics in market behavior of an individual return stream that does express repetitive patterns, all of these things in relation to that unique market. However, that's what I regard as the behavior that we're not concerned with. So when I'm like Bruno, I have limited capital, so I do have to make a selection from a possible infinite universe of which markets I trade, and I do use a workflow process to do that. And the way I do that is that I want to ensure that my trend following models are catching outliers. So I want to ensure that, and I believe these outliers are these universal features that exist in any liquid market data. Now, these outliers are not to be confused with the regular repetitive signals that you might get in a market that is representative of its unique character. That is a convergent signal. We're after these divergent outliers, one-off events, major events. So when I select a universe, for instance, I might have all of my Forex. There might be 30 different Forex markets in there. What I want to do is I want to ensure that my trend following models work across as many of those markets which are catching outliers, as opposed to be dominated by the unique characteristics of each market. So therefore, I'm looking at a multi-market environment where each of those 30 markets presents basically a different possible data history, and I normalize my technique using ATR to ensure that each of those markets is treated the same way. And then I'm assessing how my models are catching the outliers only, not their unique characteristics. So I just want to make sure that they're capturing. So therefore, my selection of which ones I trade are those that are applicable across a far greater variety of different markets than a particular individual market that might be excluded because it has such significant different behavior to all of those other markets. It needs to be excluded from my universe. That's how I treat my selection process.
Oh, thank you all very much. That's so helpful. And Bruno, sorry, I didn't mean to gloss over your question. I think as I was getting on stage, I just couldn't hear you. But thanks, guys.
No problem at all.
Well, we can. There was one thing that in the podcast that I don't think we agree on, Richard. So it's a big shock.
What?
Yeah, yeah. So I mean, it's rare, and I think we shouldn't shy away from that. We're not always going to be in agreement. So maybe a relief to everyone else that I do think on my own, but. Yeah, so I think we have a small, minor disagreement or a small difference of opinion. Yeah, I was prepping for this. I didn't want to say disagreement, but yeah. So I heard it the way you described when you and Niels were talking about sample size, and so you seem to focus on something like, and I'll just paraphrase it, and you can explain it. But it was something like 500 outlier trades. Now we have 500 outlier trades. And so now we've increased our sample size. If we trade lots of markets and we look at big back test, and now we have gone from one market that had one big outlier to now we have 500 outliers. So we've increased our sample size, something like that. So then, as I've said many times, we look at it a bit different. And that is that because we're trading all of the markets the same way, and the longs and the shorts, without regard to any of the characteristics of the markets. We're just treating corn and crude the same, longs and shorts the same, and we're doing a 30, 40-year back test. We have 5,000 trades, one entry, one exit, and a stop loss, right? And so we're trying, and then the more longer term we go, the fewer trades we have, so that's kind of a bummer. But we look at those trades not segregated by was it an outlier or not an outlier, which is what I think you were saying. But we say, oh, we have 5,000 trades. Very few, only 500 were outliers. but we count all 5,000 as our sample size. We trick the market, we trick the statistics or whatever by saying, because if you looked at our trades, someone would say, well, wait a second, the only trades that really mattered here were those 500. And so, isn't that your sample size? We would say, no, our sample size is the trades that fell underneath this umbrella of our one entry, one exit, and a stop loss. And oh, yeah, I didn't even really notice over there that, yeah, there are 500 that dominate the entire performance. But we captured those doing the same thing that we did on the other 4,500. And it's, from a sample size point of view, it's irrelevant to look at um, those outliers as anything different from the ones that made a little bit of money or lost money.
Jerry, have a read of the blog. I think you'll find we're in total agreement here. So this is how I phrased it. I think I phrased it this way in the podcast. Maybe I didn't, and maybe that's the error. So when we have a return stream, let's say a single return stream of Euro USD using our trend following models, you might have 5 systems applied to that particular return stream. In that trade distribution we generate from that, we might have 5% of those total trades. So let's say over a 30-year time frame, we had 100 trades. 5% of those 100 trades or 5 trades are actually our outliers in the series. 95% are the linear noise that we also have in that series. So our total sample size is 100. So when we then diversify to 30 other markets using exactly the same models, exactly the same principles, treating markets exactly the same way, we potentially have 100 times the number of markets we're diversifying into with our sample size. That's our total sample size. Now, in that breakup of that single return stream where we've got maybe 5 outliers and 95 linear noise events, that means that we get, say for instance, each return stream delivers the same number of relative outliers in the return stream. So when we go to 100 markets, we've got 5 times 100. So in that series, we've got 5 times 100 outliers in that series. But accommodated with that, we also have 95 times by 100 markets the amount of noise at the portfolio. So our total sample size is 100 trades per market by 30 markets, or 3,000, whatever, the 3,000 is our sample size. But this is the key thing. The outliers are non-linear in magnitude. So they have a higher magnitude than these linear events. So while our portfolios carry more noise through our diversification, they carry 100 times more noise. This is linear noise, but they're also carrying 100 times outliers that are non-linear. So the relative proportion of P&L you get from your outliers is significantly increased, as opposed to a linear relationship between our outliers and our noise. That's why when we diversify across 100 markets, we're actually, in this hunt for outliers, we are getting more pound for pound outlier impacts expressed at the portfolio level. And then after that with Niels, I then went on to, well, how does look back then also further distill that presence of relative outliers at the portfolio level? And that's where the long look back, I got into discussion there. But I think I'm totally agreeing with you there. Is that the case?
Well, we did it. Yes, we still haven't found the one thing yet. So that's fantastic. I'm joking, but that's great. Yeah. So I can't wait to read the blog. Like I said, I have to go over the transcript from YouTube transcript and look at this stuff very carefully so I don't miss anything. But
I'd be
yeah,
dashed if we didn't agree with each other 100%, Jerry.
exactly. And then there was this article I mentioned that someone in Clubhouse found it and sent to me, and I would recommend everybody look up this article. It's about Bill Eckhart, and I think it's something called "The Man with 1,000 Systems," and it's a bunch of years old, but he goes in depth on sample size and the need for more sample size with the non-normal distribution type of method. But those guys just hammered on us with sample size. That's all they wanted to talk about. 1983. So that's why I keep repeating it, because I repeat good stuff that I learned a long time ago that I really believe in. So that's really the most important thing for me. Okay, so let's give everybody a chance to ask a question or make some comments before we get ready for get on with our day and our weekend. Anybody have anything? Anybody want to?
Yeah, I would like to come back to this point that Richard and you, Jerry, brought up. These outliers and sample size and things like that. Richard, have you looked at the area under the curve or the integral? In this, I'm assuming you're doing a representation of how many R's do you make versus frequency of breakout. So you should have a distribution that has a very long wide tail and a lot of mass in a couple of hours, and then very few but very juicy outliers. So have you measured the relative size of the two areas? So let's say if we conditioned on 5 hours or 6 hours, how much return can we find versus the first versus to the left and to the right of that conditioning point? Is it something that can be done, or is it just something that you wouldn't recommend doing?
Bruno, look, I haven't done it. What I do for every single market I trade is I do look at the market distribution of returns over a large sample size, and I do plot it diagrammatically. What I'm looking for is, in my world, a leptokurtic distribution. If I don't get a leptokurtic distribution, that tells me that there is a signature of that market which is not generating these tail events. There is something that is suppressing that tail event character. And I get a bit suspect about that particular market because by far the majority of liquid markets I test over very long sample sizes at the daily level. Now, I'm only doing this at the daily return stream level. I find that the vast majority have this leptokurtic profile. And I like that because, that therefore says to me that with my technique, which is pretty infrequent in its sample size because I'm medium to long term with these particular things. I do find that my models, because they are fairly loose pants, they do tend to, when I get a transform of my trade data series, I do find that I get significant positive skew. I get the distribution that I'm seeking, and then I'm happy with that particular market data series. But I don't go to the level that you're talking about. I think, it's this simple rules-based process that, unfortunately, I don't have the maths to sort of support that simple rules-based process, but it works, and that's all I'm really concerned about. It's the validated nature of those simple rules I use. How well do they work over very large sample sizes? I can't get more specific than that. I think it's
No.
I
Perhaps
just don't know
I've
how to.
complicated the question unnecessarily. All I was asking for is when you plot these return distributions, is there a sort of a signature of where in terms of I presume you've got R, so how many units of risk of returns you get per frequency of breakouts. I'm assuming
Yeah,
that's
look,
how you build. Yeah, and so
yeah,
is there
I get
a
this
clear
standard
sign?
deviation range
Yeah.
away from the general mean of that leptokurtic distribution. I'm finding it between 3 standard deviations and further, plus or minus. I'm
Okay,
starting to get
so you
this
are
tail
doing that.
signature.
You
Yes,
figured out the onset of chaos, for example, or where this distribution sort of shifts gears, and
yes,
you've
I
got
do,
that,
and
and that's your outlier. That's the thing
that
that you are really
that's
looking
yes,
at.
that's pretty well, Bruno. Yep.
Jerry, do you use stops on all of your trades?
I do. I set my stop for all the trades when I put it on, and it's stop loss. So the loss, I use the ATR multiple, and I optimize that to in a range where it makes the most amount of money, I guess. And as I said before, it's also the average loss if you didn't if I didn't use a stop loss, my average loss would be the same as my systems when I use the stop loss. I didn't choose it that way. It just sort of happens that way. That when you optimize it, it's also about the same loss as if you had a system that didn't even use stop losses. So I'm not sure if I'm explaining that, but yeah, I've always done that. I've thought about not using stop losses, but um, as Richard has said, it relieves some of the risk in the portfolio, so you have fewer positions on every day, I suppose. But yeah, I see no downside to. I guess in some ways, back to the sample size thing. This is really getting deep into the weeds, but I think that technically speaking, this is another topic we could talk about later too, because I don't really understand how all this works. But it, if you use a stop loss, you essentially, cutting way back on your sample size, because I think you're only supposed to count the entry and an exit, which would be the entry breakout and the exit breakout. But then if you have an entry and a stop loss exit, well then that's another. Um, you can't add those two samples together. It's a different. And so maybe what you do then is you say, okay, I'm going to increase my sample size by not using a stop loss, and okay, the system looks really good, and I only use the entry and exit breakouts, but I'm going to use the stop loss when I actually start trading. And since the performance was about the same, I think it's okay to use the stop loss, even though if I do use the stop loss, I have less of a sample size. I don't know if that's good thinking or not. I don't really even think about things like that, but I do know that I'm never happy with these long-term systems with the sample size of the trades, but I'm doing all I can, and most people are way worse than what I'm doing.
Thank you.
Sounds like yeah, it's a more limited set where you have the stop loss rule, whereas you only have your entry and exit rules. And but if and by what you're saying, it sounds as if the stop loss is not exactly binding. It's not limiting your potential, at least not in the trade stats. But from a survival point of view, I think it's fundamental to have stop losses. It's it's one of the golden rules, right? It's cut your losses
Yes.
short.
Hmm.
That's right. I agree. And once again, that's why I would choose that particular example of where I would not pay attention to the back test, because with slippage and cost and hassle, hey, we can. I think look at the back test. We don't need stop losses. We can. The average loss is the same as our stop loss that we optimized, and then that's just assuming that the future looks like the past. And then all of a sudden something happens and we start seeing a proliferation of these losses that are multiples of what the stop loss would have been. And that's why I have a list of things that I don't pay attention to in the back test, because it could change. And if it's, I would trade with a stop loss if it was a bit worse than no stop loss, right? Of course. Um, but it's about the same, then that makes me want to trade with the stop loss even more to make sure I don't run into a tough situation that we've never seen before.
I want to say that as I remember in one of the episodes of Systematic Investor, Moritz said that I don't remember exactly his words, but he said that he doesn't know any much more effective instruments to be safe than stop loss. I don't remember exactly, of course, but there was his point, and I totally agree with this. I also don't know something that I uh, see as a much more safe that will help me to save my money in a such way. So for me personally, stop loss is very important, and I don't see my trading systems without stop loss at all.
All right. It's been fun, guys. Girls, let's pick it up next week. Hope everybody has a good weekend. And please take my advice on the Top Traders Unplugged podcast and the blog and all that fun stuff. And everybody take care and stay safe.
Yes.
Thank you, everyone, for your
Thank you
time.
all.
Thanks, everyone.
Take
Have a great
care.
weekend. Bye.
Bye.
Thanks, everyone. Bye-bye.
Thanks, everyone.